Let's talk a little bit about Federal Reserve and related matters. We welcome back to the show Michael Faulkender, former Deputy Treasury Secretary, and Dan Clifton, Strategas Head of Policy Research and All-Star. So the headline, Dan Clifton, start with you. The headline in the paper, Fed minutes reveal little appetite for rate cuts. And in fact, they had a bunch of people that are talking about raising their target rate, not cutting it. That doesn't sound as appetizing to me as I'd like it to sound. What do you make of it?
Yeah, well, first, let me say, I think that those views will change as we get through the course of the middle of the year and you get a new Federal Reserve chairman that comes in. But you have a bunch of new Fed regional presidents who believe that tariffs are inflationary. They've been fighting against any type of rate cuts. And in fact, it's actually worked quite the opposite. The tariffs are not having the inflationary effect that they're going to have. So we anticipate that the Fed is not going to cut rates until the new chairman gets in there. Maybe you might get one before then. But once you get a new Fed chairman in, it's off to the races. And we really don't need to be cutting rates right now. You have a massive fiscal policy coming in, particularly companies doing more investment because of the 100% expensing. And you are finally getting the consumer aid, which should have showed up last year, finally coming this year with refunds. Refunds are up, Larry, over 20% year over year, and we just started the refund process. So broad consumer and business tax cuts buy you time. Then you're going to get the Fed rate cuts in the second half of this year. I just think the Fed continues to be wrong, but help is on the way because Kevin Warsh is coming by mid-year.
Well, help is on the way, Mike Faulkender, but this raises a question, though. Steve Myron was on the show last week or the week before, and one of the things he mentioned is the Federal Reserve's economic model, which always predicts 1.7%, which is really a joke. I mean, we're growing at about 4%, and who knows, it may grow higher than that. Point is, they have no channel, no deregulation channel. They have no idea. Trump is going to deregulate the, I mean, you just had the announcement saving over $1 trillion of the EPA deregulation, okay, and the endangerment clause. So how can they know what's doing on the economy when they don't? One of the biggest policy initiatives, probably worth $2 trillion when it's all said and done, of deregulation, which is great for business, it'll be great for wages, it'll be great for consumer spending and so forth. They can't even model that. And here they are, some of them want to raise interest rates. Go figure.
Yeah, Larry, I mean, you saw it during the first term of the Trump administration that when the president came in and engaged in significant deregulation, we had growth without inflation. Biden comes in and unleashes trillions of dollars in excessive regulation on the American economy, and we get the highest inflation rate in 40 years. President Trump is now undoing that, and again, the Fed models don't show it. Now, let me add to something Dan said about the regional presidents. Until we clean house a little bit at some of these regional presidents, I think that Kevin Warsh will continue to have some difficulty. I hope that there is going to continue to be deference towards the new chairman, but I worry that when you've got people like Austin Goolsbee, who everybody should remember was Obama's CEA chairman and is now the Fed president for Chicago, he's a strong voice out there that is saying that tariffs are going to be inflationary and that deregulation has no impact on the economy. And so I think until you take another look, and one of the things Powell did is he just renewed a bunch of the Fed presidents for another 5 years. I hope that Kevin Warsh will take another look at some of these regional presidents and see whether or not we can move some of them along.
That was a tremendous mistake. Every 5 years you get these votes, and I was a unanimous vote. The board said, fine, you can all stay longer. And I agree with you. And Dan Clifton, also, you know, we talk about there's no model for deregulation. I don't know model in the Fed for supply side tax cuts either. And there's no model for 100% depreciation. I mean, these are hugely important things, and they bring down the inflation rate. I mean, I think supply side tax cuts create more goods. If the money supply is stable, that's going to lower prices. Deregulation, that's an inflation fighter, but they don't have it in their models, so they don't know how to do it.
Larry, let me take this one step further. You're absolutely correct. Vice Chairman Bowman of the Federal Reserve is about to put out a very significant financial deregulation that's going to unlock hundreds of billions of dollars of capital that is going to reallocate and more efficiently allocate that bank capital to create lending, to create jobs, to create investment. And they have models, can't even model for what they're doing.
Right.
That's how insane this process has become. So that's why you need a change in leadership, and that leadership should direct down from there. I agree exactly what Michael said. There is a resistance that will be built into the Fed that will oppose that new chairman, but he should get some deference. And I think at the end of the day, if Larry Kudlow is right, the data will take them there. Inflation will continue to come down, wild growth's going up, and they will have the flexibility for these types of changes because the deregulation story is far more powerful than their models can suggest. They'll come up with some other reason for it, but the Keynesian, Phillips curve models are going to be out of vogue with the leadership at the Fed, and that's the most important.
It's just got to be. And I think Kevin Warsh, who served at the Fed once upon a time, not so long ago, he knows, where there are good bodies and where there are bad bodies. And I think he'll know what kind of changes can be made. But, Mike Faulkender, people are going to laugh, but I've said this before. I think the 2026 economy, for all the reasons that Dan Clifton and you are talking about, that thing can grow by 5%, and the inflation rate, all right, wait for this, the CPI could come in less than 1% for the year. Less than 1%. That is a possibility. And you know what? Once this Iranian war is settled, we're going to fix that, and the president's going to fix all that, you're going to see those gasoline prices come down even more. And as you said to me a couple of years ago, energy permeates prices all in the economy. 5% growth and less than 1 on the CPI, Mike Faulkender. I'm going to give you the last 30 seconds.
Yeah, so Larry, you and I know, and we witnessed it in the first term, that when you have the combination of deregulation, tax reform, cutting wasteful government spending, and unleashing American energy dominance, those are the ingredients that you need to bring out productivity. And it's the productivity improvements that the Fed should be modeling. It's not that difficult, it seems to me, to go change these Fed models to say that rather than productivity remaining really low, that AI and unleashing energy are going to boost productivity. That's what gives you the growth without inflation. That's the type of model modification that I think Kevin Warsh can come in and cause the Fed to change in order to update these models, because 1.7% economic growth totally underestimates the potential of this economy.
Thank you, Mike Faulkender and All-Star Dan Clifton. We appreciate it very, very much.